Dear participants, we'll start the program at start. Your smile is your logo. Your personality is your business card. How you leave others feeling after an experience with you become your trademark. I am Anushra S. student, Department of Studies in Commerce, Mangalore University, and here's wishing you all a pleasant morning and a warm welcome. Multiple waves of coronavirus pandemic are challenging humanity as never before. But the spirit and hope has helped us cope through the ages. Hope is being able to see that there is light despite all of the darkness. With that hope and positive thought, Mangalore University Department of Studies in Commerce has organized this online workshop come 3-day conference series 2021 on corporate governance and financial management. Now, it's time to begin with the first section of the day. Corporate governance and financial reporting can be understood as an information gathering system that involves both management and the recipients of those information outside the company. To provide more detailed information about the topic, corporate governance and financial reporting, we have with us today Professor B. Ramesh, Dean, School of Management and Commerce, Mallareddy University, Hyderabad. It's our honor to have you with us, sir. I now request the moderator of the section, Mr. Abhinandan, guest faculty, Department of Commerce, Mangalore University, to introduce the resource person.
I request just briefly introduced by my designation and my previous organization. That's enough. Don't read the biodata. That's enough. My sincere request to you.
A very good morning to one and all who present here. I take this opportunity to introduce the keynote speaker of today's session, Professor B. Ramesh. Professor B. Ramesh is currently working as Professor and Dean of School of Management Commerce, Mallareddy University, Hyderabad. Sir has a teaching and administrative experience in the state university system in India for the last 37 years. Sir worked as head of the Department of Commerce for 15 years and as a dean of the faculty, Goa Business School, Goa University for 6 years. Sir guided 18 PhD students and 15 MPhil scholars till the date as a research guide. Sir was adjudicator for more than 100 PhD works of various universities in the country and published more than 100 research papers in reputed journals. Had organized 25 UGC HRD refresher course at Goa University to train more than 1,000 senior faculties in commerce and management. Yeah. The significant webinar was of Vice Chancellor's Conference on New Education Policy 2020. Sir served as the President of Indian Accounting Association in 1999 and as a President of Indian Commerce Association and also served as a member of Executive Board of Association of Indian Management School from 2015 till date. Once again, a warm welcome to you, sir.
Yeah, thank you very much. Now, can I take over the session?
Yes, sir, you can take over.
Yeah. So, thank you for your warm welcome and wish all of you happy Ganesh Chaturthi. And first of all, I need to apologize for my absence yesterday because of some issues which I need to share in the last minute. First, Professor, I think there's some audio disturbance from someone. I think you need to instruct all the people to mute their audio. All the participants should mute their audio.
Participant, please mute your audio while joining.
Okay, and now this is my privilege, and I'm very thankful to Professor Veda, who contacted me almost a month back regarding joining this kind of program, and then requested me. I said fine, despite because this is almost the first program I'm joining in any kind of conference or FDP after I joined the Mallareddy University just a month back. So therefore, the credit goes to Dr. Veda, who prevailed upon me to join and he had not given me a choice whether to join or not to join. So fine, thank you. And I congratulate all the faculty members of the school and also the participants who have joined this program. I'm sure that you must have enjoyed the participation of all of you on such an important topic of this corporate governance and financial management. And the corporate governance is not necessarily related to only finance area, but it's all related to every aspect of the functioning of corporate life. But then this is the more important area of all the other areas. So that's how I congratulate Professor Vedava to having chosen this thing. I'm sure that you must have already gone through the Nikkei areas of the concepts of corporate governance and other things from various experts till now. So in fact, I had a different plan of my presentation, which I shared with Professor Vedava. And now, yesterday I realized, and then I changed my PPT, and today I shared a new one. And this is exclusively on corporate reporting. I'm sure that all of you would try to pay attention, which is the most important thing. Now, this has become an issue for even professional institutions like ICFA, and then instead of company secretaries, Ministry of Commerce, SEBI regulatory bodies, and then stock exchanges, and the companies in terms of compliance of reports that they have to submit to the regulatory bodies, ministry, as well as also informing through their own websites, company websites, for the public information as well as to the other stakeholders. So it is an important aspect where the governance of the companies is seen in a different angle after the corporate governance has come into the picture. I'm sure that there are many institutions which are also offering training program in terms of corporate governance. And I remember in Bangalore that COD Institute, IOD Institute, which is engaged only in corporate governance training program. And I did a 1-year program with them on this. And then I'm given the letters that I need to use after my name, having successfully completed this corporate governance program of theirs of 1-year duration. But normally I don't use it because it's only for professional knowledge. And I'm sure all of you need to do the similar kind of thing, because if you are in the area of finance, especially in terms of reporting. Now let me start, and I request the one, because I had some hiccups in terms of sharing, because this is the only platform Cisco I always have some problems. And even in Mangalore University, the university has subscribed for this. And then after I joined, I asked the university to shift to the Google Meet, and they have already accepted. And now very soon we are shifting to the Google Meet. But nevertheless, so we are putting up with that. Otherwise, I would have shared my own PPT. So I request the one, whoever sharing, that when I say next, automatically you move to the next slide. So can you please now move on to the next slide? I only say next. That means automatically you need to move to the next. So now I'm not going into the details of the concepts of corporate governance and everything. Now, straight I'm focusing in terms of financial reporting, which is part and parcel of compliance of the corporate governance, in terms of both the mandatory as well as the voluntary disclosures, so that the companies are expected to follow. And there are many companies without even the mandatory requirements. They are now having acknowledged the importance of this corporate governance. They started using this in order to build their own goodwill among the stakeholders of the company, in the public, and more so with the shareholders. So that is how, and the voluntary disclosures, which are not mandated as part of the CG, is something is now we are witnessing increasingly by various corporates in India. So this is one thing that we must appreciate. And especially this kind of voluntary compliance is coming from the startup companies and also the companies which are not required to meet the corporate governance in terms of net worth or in terms of the net profit, what they are making up. So that is considered to be a welcome sign. But the big question mark is that what is the extent of the companies which are established for years together, reporting their profits, and then also leading with leading market share and also high market capitalization, high market share prices, though they are subject to volatility. And this is where the volatility concept comes in terms of what kind of corporate governance policies that they are making. And many of us, we are doing research works in terms of the extent of measuring the price volatility in the stock markets. We have done a lot of research works. Even in Goa University, we have done many PhD works, and still many works are going on because that is a continuous effort and new revelations come from time to time. What has happened in the past 5 years back in the stock market is no relevance today. So therefore, this is a continuous effort with new revelations that one has to consider. So therefore, it becomes an imperative that these research work should continue in terms of new findings. And this is also an area where corporate governance. Now, I remember at least two of my students have done on corporate governance in terms of their doctoral work uh, during the last 5 years, and one more is still continuing. And in Goa Business School, there are at least another five people who are working. And I understand even in Commerce Department of Mangalore University, they are also working on this with Professor Ishwar and then also Professor Vedava and other people. The message that what I'm trying to tell you is that all those who are interested in the finance area, these are the niche areas where you need to focus. And I'm only giving the direction for your future research in this area. So these are the areas, and every aspect that I'm talking about, financial reports, compliance, as part of corporate governance, is a bigger issue. It is not that one should take a PhD work in corporate governance. Corporate governance is a broad area, but then one need to focus in terms of each and every aspect of financial reporting. So that's where you need to come out with what are the practices. Unfortunately, we don't focus in terms of the case studies of various companies. Now we find every day a new company is coming out with a lot of deviations in the financial disclosures as laid down by the SEBI, and then as part of the corporate governance. And you must have heard of Kavi Group chairman, and he's no less than a perfect chartered accountant. Kavi Group was started by five chartered accountants, promoters, and today is a big company, and it had a history of non-compliance in the past also, and then uh, being a listed company, it lost its credibility some 10 years back, and now it got revived. But again, the recent last 6 months, you must be knowing that the chairman and the directors are now in the custody of EDI. So this is what means the corporate governance and the compliance of disclosures, financial disclosures. So these are the classical cases what you come across. This is only one such example that we have right in front in the current period. Likewise, there are many other companies. So that's how I'm trying to focus. This is an important area. Earning profits is the business. There's absolutely nothing wrong about it. But then earning profits and then reporting profits and then disbursing the profits, and also in terms of enhancing the value of the corporate value and the business value, valuation of assets, valuation of profits. So these are all the areas which fall as part of the corporate governance. Corporate governance is nothing but that how best you govern your company, being the management, being the promoter, being the chairman, because everyone is playing his own role, including the auditors. And remember, auditors are not away from this. Auditors are also auditors, statutory auditors, internal auditors. Everyone is very responsible for this kind of thing. So that is how we start with the financial reports. Now you can say chairman's report, financial statements, and all of you are aware that when you open any financial statement of a company, if you are a shareholder of a company, you are bound to receive the financial statements by a registered post. I'm sure all of you would be receiving it, even I receive it. But then how many of us we read that? We don't bother. But then we still teach that this is what is supposed to be followed. So these are all the statements. Next. Qualities of financial statements. The previous one, what I spoke is the what constitute financial statements, which you always teach your students. So there's nothing wrong about it. But then the qualities of financial statements, where it should be clear, understandable. Now, next thing is most important thing. So every company, by its virtue of the regulations of the stock exchanges, for those companies which are listed in the stock exchanges, it is mandatory for them to publish their annual reports in terms of financial statements. And then these are what we consider as reliable and honest. This goes without saying. So we don't need to pronounce it. But then unfortunately, we need to stress on this as many companies resort for this kind of thing. So reliable, honest, and with no frauds, no video dressing, and properly audited. And many times the audited reports are not timely available because the investors and other stakeholders of the company have to take decisions during the financial year before the audited reports are available. So unaudited statements and audited statements are part of the necessary procedure that every company has to follow. So in the absence of that, and in the absence of non-reporting of that, this becomes a kind of lack of information from the for the stakeholders to take their own investment decision, whether to continue or not to continue, how they should put their long-standing position in the company or short-standing position in the company, and then how you comply with the laws in terms of the Companies Act and various other laws, FERA Act, and many other if you are an international business organization. And then rules and practices, and professional practices, ethics that you need to follow. So these are all the aspects of qualities of financial statements. Next. And you understand, I won't stress much on that. What are the functions of financial statements? But the point that I'm trying to drive is that these are the financial statements which become the means of communication about the status of the company in terms of financial performance during a particular period in the last financial year. So these are to be done. And now we are having mandatory requirements for all the listed companies where quarterly requirements are also important. It's not annual, quarterly, half yearly, and then annual. And even the audit reports, the audit reports in the middle of the year, end of the year. So these are all the compulsions that have come as part of the regulation by the stock exchanges, regulation by the SEBI, and to some extent companies volunteering on their own. And functions in terms of to be performed from the angle of stakeholders, from the angle of the control function, because it is not necessary for disclosure, but also in terms of managing the situation. The management should have the continuous reports for corrective action in case of something going wrong in the different direction or wrong direction. So management requires, and that's how management accounting is so important in that. And also for planning in future. So in terms of from where we are and where we need to go. So the planning of the future is important. For that, these financial statements are important. Next. And it is also important that investors need to know, and that's because they have their own investments. And then the ratings of the instruments in terms of shares and bonds is important, because these are the ratings which makes them comfortable. If they have already become the shareholders or the bondholders of the company, the ratings are important, because the investors do not have their own self-assessment of the credibility of the company. So they mostly rely on the ratings what they get from the rating agencies, which are supposed to be professional rating agencies, which are independent, nothing to do with the company. But then they work out their own ratings and then try to disclose it. So the investors go by those kind of ratings. Investors in terms of investment in shares or the bond, and then if some investors are medium term or short term, they need to make a decision whether to hold on or to disinvest. So for them, and also in terms of pricing and valuation of the company, from the angle of the acquisition and mergers, because this is another important thing, because the every company is eyeing on the competitors and also eyeing on the potential threats to them. So in case if a company is coming out as a potential threat, they try to take over that company so that they get the advantage of mergers and also acquiring such kind of company. So the management always looks for such kind of potential threats which come up from various sources. So mergers and acquisition. So next. Now, it's a question of misleading statements that need to be ward off. That many companies try to give misleading statements because they want to mislead the stakeholders in terms of shareholders, the stakeholder in terms of creditors, stakeholders in terms of consumers, stakeholders in terms of employees, and so on. Everyone will be misled by the unscrupulous, uh, the management, and also sometimes the I would say promoters of the company, including the directors. So deliberate false picture of the company, so that the company is not doing well, and they people try to disinvest when the company is in fact is doing so exceedingly well, because they want to reduce the stock price by the false statements, so that the stock market reacts adversely towards the stock price of the company, and then they take advantage and then they build their position in that stock. And not only that, the group who with whom collision is done by the promoters or the directors or management, they try to do that. So misleading statements in terms of accounting policy in terms of revenue and expense recognition. I'm sure you know that how adversely it affects the profitability position of the company by understating or overstating of the revenue as well as expense reported in the profit and loss account, and then not following the distinction between capital and revenue expenditure. One can influence your profit and loss account reflection. And similarly, in terms of income and liability distinction between the capital and income and liability in the sense that whether it is going to be a liability in future because deferred expenditure always is a liability instead of showing that as a current.
Hello, sir. Your voice is not audible, sir. Sorry for the technical inconvenience. We will resume the session short while. Hello, sir. Hello, sir. Hello, dear participant. Sorry for technical inconvenience. We'll start the session within few minutes. Hello, sir. Sir.
Hello, can you hear me?
Yes, sir. Audible.
Okay.
Okay, sir.
I was trying to ask the participants to respond to my question, and then suddenly it went off. Uh, Hello?
Yes, audible, sir.
Yes. So I was talking about these misleading statements, and then I asked the participants in case if they want to ask me a question, they can ask. Because I otherwise I won't know whether I'm continuously talking, but whether you are able to listen to me or not. From time to time, I need to interact. You need to also speak to me. Then only I can ensure that I am there online. So, can I ask any participants to respond to me if any query that you have so far. Quickly. Any participant.
Actually, we have a discussion at the last.
That's fine. I understand that.
Okay.
But toward the end, it may be a different kind of thing. But so far, I have asked.
Okay.
Okay, all right. So now move on to the next slide. So now, in terms of all these statements, what I've said, I try to bring in case number 1, 2, 5, 6. Now let me tell you how a deliberate false picture can happen. And in terms of false picture, a company wishes to show a higher profit if it can, in terms of overvaluing of the closing stock, and also not to make expense accruals, but the accruals are supposed to be shown as per the fair and accounting practices. All expected expenditure need to be shown during the current year, but then which are we are calling as accruals, which are not shown as a result of that, the current year's profit will be high, and overvaluation of closing stock will show higher profit. Not to make various provisions. Here you are supposed to make provisions for expected liabilities and obligations. You don't make provisions. As a result, you show higher profit. And book false gains through sale, purchase, back. So these are all the deliberate false picture that you create in order to boost your profit. So you want to show higher profit to various stakeholders. So this is case number 1. Next. Case number 2. Next. Misuse of accounting policies. The accounting policies that we need to follow, it is a judicious uh, policy that one company has to follow according to its situation, because there is no standard except the situation. According to the situation, the company has to follow the policy that is suitable to them in terms of the position in which the company is in. So there is no standard that you must follow only this policy, depreciation policy, or income recognition policy. So it is open. But at the same time, you need to declare that when you are following a particular policy, you need to declare this is the basis on which we are following this policy. So unless you declare that, then whatever policy that you are following is going to be meaningless. As a result of that, the companies use their discretion. They follow a particular policy of deferring depreciation or deferring expenditure. And sometimes when you earn the revenue, you don't show it because deliberately you want to create that kind of position. So these are all the, in terms of revenue recognition, you have the misuse of accounting policies. Revenue recognition in terms of book value, in terms of the deferring the revenue, in terms of expense recognition, deferring expenses, and make unreal provisions which are not exactly existing, so that you want to undermine the profit disclosure during the current year. So misusing of accounting policies. Case number 3, next. Playing with debits, and case number 4 is playing with credits, which will lead a misleading picture. So how do you play with the debits? Show higher profit by capitalizing your normal revenue expenses. So you need to recognize there's a clear-cut demarcation and accounting standard which is defined between recognition of revenue expenditure and capital expenditure. But then you take a cue from some XQ, and then you use your own jurisdiction of recognizing capital expenditure as revenue expenditure as capital expenditure according to your convenience. So if you want to show high profit, then you undermine the capital expenditure and show as a revenue expenditure, and vice versa. And similarly, in terms of deferring the start of depreciation, you may have a gestation period little longer if you want to show more profits. So it depends on that. So playing with the debits. Debits means debits on the debit side of the profit and loss account, trading and profit and loss account. And also sometimes you show low profits by showing expenses which are of capital costs. So these capital costs are supposed to be capitalized, amortized over a period of time, not in one accounting or one financial year. But then you try to show them as expenses in 1 year rather than multiple years in future. So these are all playing with the debits. Next, case number 4. So here is the case with playing with the credits. Like as you have done, when you play with debit items, so then you are trying to show more profit. And when you play with the credit items, you are trying to again reflect and escalate your profits. Or if you want to show less profits, you try to recognize less income on the credit side. So that is in terms of the example what is explained here in terms of advance from the clients or taxes, which is not reflected in the profit and loss account on the credit side. And you might have taken a loan through special vehicle purpose and then treat it as an income, which is not exactly the real picture. You show that as an income. A loan is taken through special vehicle purpose and then it is shown as an income. So show low profits by treating revenue as a liability. And of course, so the classic example is Microsoft company, which has resorted for this kind of thing in more than one financial year. Next, case number 5. Change in accounting policy. So change in accounting policy, as you understand, every accounting policy, whether you follow any straight line method or depletion method or any other annualized method, every accounting policy will have the expense of depreciation, which changes from policy to policy. Now, according to your convenience, as all of you are aware, that the companies resort for this kind of shifting from one policy to another policy without giving any kind of basis for shifting of the accounting policy. So that is also another gimmick which is played by various corporates. And the example is in terms of valuation basis. You also change the valuation basis, and also you change the depreciation basis. So these are depreciation basis in terms of depreciation methods. Valuation basis is in terms of market value method or the cost value method. You, according to your requirement, you change the basis, and you, of course, it is reflected, it is reported, but then that reporting is a deliberate reporting in order to manipulate your accounts. That is what exactly is the change in accounting policy. Next one, in terms of compilating financial statements, where a company has multiple operations, multiple businesses in multiple countries. So you have all the means at your disposal where you want to project one domestic company or one company. So if a group of companies are under one management or with majority stake of management, So it has to be a consolidated financial reports of all the group companies. So that is the mandatory requirement in terms of regulation. Many companies don't follow this regulation. So they create complicating financial statements for each of their group, for each of their operations, for each of the country. So as a result, the true picture of the whole company is not known to the stakeholders. Okay, next slide. So now, uh, what is the responsibility for the health of the financial statements and who are the responsible people? These are the responsible people: the board of directors of the company, the management of the company. The board of directors, we talk about all the promoters as well as the uh, directors, independent directors, and other directors who have the stakeholding in the company. The management, the executive authority working under the board of management, board of directors, then external auditors. And remember, the external auditors are very crucial people who normally in convince with the board of directors and the management, they try to project the picture. I think always the independency of the external auditor from the management is something which is missing in the Indian corporate sector. So they all in collision, they try to do that. And that's why some regulations have been brought in. I will share toward the end of that what are those regulations with regard to the external auditors, independent auditors. Then external bodies, we have various regulations of accounting bodies, and then also in terms of trade associations. The next slide. The board role is in terms of NEDs, IMDs, audit committee. The next. All these people whom I just mentioned, the role of the management. So role of management, which is the executive authority working under the board of directors, have to draw the accounting policies, keep accounts, and prepare regular financial statements quarterly, half-yearly, annually for the purpose of compliance with the stock exchanges, and then reporting in their own websites for the information of the stakeholders. And the management also moves to gauge lose from the defects of the financial statements. So the management is supposed to be accountable for all these kind of mistakes, either in terms of defects in financial statements, either by losing, because if the financial statements are wrongly prepared, the management is responsible for it, and they have to pay a price because they are working as custodians and the trustee on behalf of the stakeholders of the company. So they must own the responsibility and accountability for any kind of false statements and defects in the disclosure of financial statements. And also in terms of management, which needs highest degree of monitoring in this aspect, which many a times, because we have management accounting, we have cost accounting, we have financial accounting. So the management is responsible for all these three branches of accounting, and then continue to monitor the information from all these three branches, and then take management and financial and accounting decisions which are appropriate. And the moment they lose sight of this accounting information coming across different floors of the accounting sections, so that means that reflects a bad image on the management. The next. So that's the management role. External audit role, which I said this is the most crucial thing. The board of directors are playing their role, management is playing their role, and then who is supposed to make a judgment on the role played by the directors and the management is the external auditors. Internal audits again is part of the internal organization. Their role is minimal. Their role is only in terms of reporting information, what's happening, and then the board of directors and the management they try to take their decision on the basis of internal auditors information. But the extra auditor role is more important because whatever it is something like that, what we call as dissection of accounting. Dissection of accounting in the sense, accounting information that you dig in terms of the pros and cons of whatever you have done in terms of your processing of accounts in the past. And then the auditors, external auditors, show you this is where you faltered, this is where you have not done enough. There are two things. One, in terms of faltering, and then the second reporting aspect of external auditors is in terms of what you have not done enough. And then if there are some kind of misrepresentation of accounts which are done, the external auditors have to bring those uh, defects also to the limelight because these are an independent body, external, as the name indicates, these are auditors who are external to the board of directors, external to the management of the company. And these are the people who are trying to protect the interest of the stakeholders who are not part of the company's affairs. So, on behalf of the stakeholders who are external to the company, these people are playing the role. So they are not part of the board of directors, they are not part of the internal auditors, they are not part of the management of the company. They are external in terms of on behalf of the interests of the stakeholders, being the shareholders or creditors or anyone, or general public or even consumers, they need to know. So everything that they need to bring into the limelight. So here are some of the roles which I explained in terms of independent directors. The concept of independent directors has assumed so much importance that the company has to have one independent director. Every company has to have one independent director on the board, which is nothing to do in terms of his interest in the company. I think as we being professionals, uh, being professional in the area of finance, the doctorates, and in the area of finance, have the most opportunities to become the independent directors. So unfortunately, this is again is going according to the whims and fancies of the top management and the corporate directors. The only thing, as we being academicians, so we can also become an independent director in any company. If you have a doctorate degree and if you have sufficient experience in terms of research in the corporate sector, I'm sure that you qualify to become an independent director. And except that you have to do a course on the independent director's role, which I was talking about IOD, which is based in Bangalore. So once you do that course, then you become eligible to become a director of a company as an independent director. Remember that. So without any kind of affiliation to a company or to company's management. Next one. External audit. What is the purpose? Purpose I have told you that they are supposed to take care of the interests of the interested parties who are external to the company, stakeholders. And it is the purpose is to obtain an opinion in terms of the financial reports. And they are also supposed to fix the financial statements, whether they are in right direction or the wrong direction. And you need to report unqualified, qualified disclaimer as well as adverse things as far as the financial statements are concerned. So that means you have to qualify all the accounting policies, the prudence practices of financial reporting, whatever are they qualified, you will say, yes, these are qualified decisions of the management. And if they are unqualified, you have to state that. That is the duty of the external audit. If a company has taken a wrong decision in terms of involving some kind of loss of interest to various stakeholders, that you must bring out that this is unqualified decision taken by the management. So in terms of your financial auditing as an external auditor, so you have to bring in qualified statements, unqualified statements of the financial position of the company, and you should also say that if some decisions are taken and then you say that there is no basis and no one can claim anything on that, which we call as disclaimer. And if any decisions are taken adverse, which is wrong in terms of deviation of the purpose, like yesterday you heard of the topic of trustee agency theory, and then the corporate governance, which was shared by Professor Mallikarjunappa. This is what exactly is that, because the auditors have to bring in, if there is no distortion relationship between the trustee agency theory between management and the stakeholders, so such adverse reports have to be brought into limelight by external auditor. Now imagine most of the corrupt practices what we are coming across in the market are not out of the external audit, except few one or two cases. In case of Satyam, yes, we have got external audit. Satyam, it has not come, but then subsequently, then it has come somewhere, and even external auditors were booked in case of Satyam, which was a classic case, a financial, uh, uh, what I would say, the failure. And the recent episodes also that have happened, most of the cases have not come out of external audit. So hardly you come across through external audit. Even in case of this Carvi, it has not come through external audit. The failure of this one was not part of the external audit. It has come into limelight post external audit. So this is where the honesty of the external auditor is to be seen. Next slide. So we know audit report and the scope. I don't need to. All of you are being commerce people, so you must be aware of it. And only one point I need to say that the audit report, the scope of that, it should essentially clarify in terms of forming an opinion. So auditors have to give their opinion on the basis of judgment of what they feel of the financial reporting of the company. So the opinion is important, and the opinion in the sense, and that is a qualified opinion. So opinion in the sense that whether it is in the right direction or wrong direction, it's only an opinion. It is not a disclosure. The audit report does not qualify. After doing complete external audit, they try to form an opinion. This is what is we feel that is not going in terms of the interests of the stakeholders. So that's an opinion, and that means a lot of stories. So they may not give the details of what it is, but then that is important. And they simply say proper records have been kept, but then if they don't give opinion that the records that are kept, whether they are in the right direction in terms of the stakeholders or not. So that's a wrong statement what auditors would give. With regard to financial statements also, they have to define very clearly as you understand in terms of the financial auditing. Next slide. errors and frauds have to be booked straight away by the external auditor. So in terms of, the one point you have to remember in terms of errors and frauds. If someone has done a mistake or an error, error is because normally you, being an accounting professor, you understand errors of formation and commission. Okay, and errors of formation means that sometimes you forget to include it. Errors of commission means you do it, but then errors of commission could be with intention, without intention. This is where we are trying to draw that. If a company has done a commission, a commission of an error with an intention, and that the role of external auditor is to decide whether it is done with an intention or without intention. You need to prove that. And sometimes it may be unknowingly or innocently, there may be an error. So that is not a deliberate error, which is a deliberate fraud which is done. So you need to distinguish between errors and frauds. Frauds are committed with an intention. Frauds are nothing but errors which are done deliberately, which becomes qualified for frauds. But simply if it's an error, errors are the errors, mistakes, not with the intention of doing any kind of fraud. So that is the distinction what the external audit committee has to do it with regard to reporting of all these financial statements. So that is the important role of statutory audit, which becomes the proper corporate governance. Next slide. So what is the auditor's liability? So no liability to outsiders, and this is where there are some cases what you heard internationally, and the auditor's liability is restricted, especially to the outsiders. These are classic cases that have come in where external auditors were not booked. But then in Indian context, I think they don't have any kind of leniency. They are going to be booked, even external auditors. In fact, if you recall, the tussle that has happened in terms of the tax obligation between Vodafone and Indian government. The case went on for years together, and finally Vodafone was made to make the payment of the tax arrears. So these are all having international ramifications, especially the foreign companies operating in India. If foreign companies operating in India with their head offices outside India, that's where the problem comes because they are governed by the international laws of regulation. But if they have their own operations in India, they are supposed to be governed by the rules of law of our uh, motherland. So this is the distinction that comes into the picture. Okay, next slide. Yeah, professional monitors of external auditors, and we have, because the auditors, external auditors, they are considered to be professionals, and these professionals also are accountable because their credit book is going to be with various bodies with whom they are affiliated, both in India as well as outside. So these are some of the bodies where they try to look for the credibility of all these external auditors, either the firms or individuals. So they are somewhere related to all these accounting professional bodies, including in India. In India also the Institute of Chartered Accountants of India. So they also take the action against any member of ICAM if they are booked under any kind of fraud. So they are also barred. Similarly, in case of other medical practitioners, if the doctor resolves for a malpractice, so is barred, his license is cancelled. So therefore, they're all being monitored by these, especially in the area of accounting, we have international models. They are barred from practicing for any foreign company, either operated outside or in India. Next, guidelines to audit firms, which are generally given. So next line. Non-audit work that normally happens in terms of taxation, investigations, general consultancy on new products, system development, global. This is where there is no audit which is being done. As you understand, external audit is only in terms of the financial reporting which has been done by a company. But these are the some of the things which are not part of the financial reporting in terms of taxation and in terms of investigations, in terms of acquisitions and then the mergers and acquisitions and so many other areas which fall apart from the external audit. But these are also many times there are frauds in terms of the companies that have resorted beyond the financial reporting. So this will not come under the audit work, but yet these are important as part of the corporate governance. So the point that we are trying to draw here, these are not part of the external audit, but then these are also part of your corporate governance. Next. So how to control non-mandatory work? These are the mandatory or non-mandatory requirements which will come for audit forms. And sometimes it comes as a provision of non-audit work, and sometimes it comes as a partial provision of non-audit work, which are defined by the nature of the or level of approval, which are with particular reference to the country in which the company is operating. Next. Okay, rotation of external auditor, which is supposed to be done. Objectives of fixing financial statements in terms of managing position, managing funds. Next. Managing position is in terms of the rules and regulations. Then the lenders covenant, because lenders are also part of lenders means the creditors of the company, and they have a certain expectation of the company when they lend the funds to the company. So their interests have to be protected, and the interests of the public have to be protected. Next, managing position in the sense managing the reflection of the company's performing, and managing the earnings of the company, which is also important. Actually, this is one of the crux of the corporate governance, earnings management, because there are a lot of leeways that are enjoyed by various companies according to various accounting standards, and then also according to our Institute of Chartered Accountant of India, they have mandatory accounting standards and then some standards which are not mandatory. All we have about 32 accounting standards. So everywhere the accounting standard is defined. But then there are generally accepted accounting principles. So most of the earnings management which the companies resort for falsification of their financial reporting is under generally accepted accounting principles. Wherever the accounting standards are given, but there also in accounting standards, so there are little leeways for the companies to define why they want to follow a particular method of treating a revenue expenditure or capital expenditure or expense or revenue. But then that leeway, many a time they don't justify. And especially this happens in the case of companies where the revenue gets generated over a long period of time, especially in contractual infrastructure firms. The most important thing that happens is in case of infrastructure companies. where the revenue recognition is very tough job there. So the earnings management is one crux area which is essential element of the corporate governance. Yes, next. Creative accounting. Creative accounting is the accounting purpose is not going to change. The accounting purpose is not changed. And then the accounting people have creation of genius creation of what you may call as creative accounting. So the word is called as creative accounting, where the legitimate intentions are different, dishonest intentions are different, and we have override fraud as well as we have double set of books which are maintained. Most of the time, you know how it is, and practically we see in most of our day-to-day transactions, we are supposed to pay GST on every item that you purchase, but you we don't insist on the bill, and if you insist on the bill, then you will add the GST. So we most of the time we avoid, and all of you are experiencing, and this happens in your own life experience when you buy a flat, when you buy a when you buy a plot, then there is no flexibility. But when you buy a flat, the GST you can always avoid by entering into a wrong, because you want to save your expenditure, and at the same time the other party also wants to get his business, so he wants to increase the volume of business. So all of us we know, and we don't have the ethics as a consumer. Your duty, for example, as a an employee, paying tax through TDS is an obligation of every citizen. If you're an employee, TDS is obligation, so you have no choice there. And similarly, when you buy a product, paying GST is your obligation. But do you pay GST on every item that you purchase for in your day-to-day life? No. Many cases, in fact, you want to avoid the paying the GST, and that is what is creeping into the system. So therefore, the business people maintain double accounts, one with GST, another without GST. Though fortunately, the GST earnings of the Central Government of India has reached to the record level in this particular financial year. But imagine if the entire system pays the GST, it could have been even double. Right. So that's what we call a creative accounting. Next. Director's responsibilities and all that. So I want to skip off this. Your next line. Voluntary disclosures. Next. So I need to just touch upon for 5 minutes. No, next. Anyway, this PPT is there with you. You can have next. I want to touch upon the regulatory committee, which is appointed for corporate governance. The last three slides, which are important. Last three. Last three slides. Yeah. Yeah, I'm talking about this the previous slide. Yes. So this is what I'm trying to give the regulatory insights. So the government of India has appointed to the SEBI a regulatory body for this corporate governance, and they have given certain guidelines. Especially, there are some 9 points which they have made it, and this is what I want to bring to your notice. Next slide. These are the key highlights. So, what are the important recommendations of this Quota Committee, which was brought in, which was appointed in 2018, and then from 2019, this has come into effect. So now, especially just 1 year before, of the COVID pandemic period has started in 20 March. Earlier to that, these were done. Subsequently, the committee, this committee has made these recommendations. But then soon after that, the pandemic period is erupted. As a result, these are not being focused the way that is required. But this quota committee has given a very clear-cut recommendations in terms of all these points what we have touched so far for the effective corporate governance in terms of financial reporting. The composition of the board of directors, which has to be very transparent. And this is where exactly I'm trying to tell the role of the independent directors here, which is mostly pronounced. And if you go into the company website of any company, anytime, so they would seek any independent director can apply. So I wish that any of you are keen to join as an independent director. You may choose any company website where and then look for the invitation which is extended. And also the Minister of Corporate Affairs website, they also invite the applications for independent directors and all of you with good standing in research background and you are authority in this subject, so you can apply. So I would, this is one cue that I want to tell all of you to make sure that you can also be an independent director. We have thousands of companies in the country, and there are shortage of qualified independent directors. Because the good thing is that you should not have any kind of relation with the company. So that is the beauty of it. So that is the minimum qualification. You should not have any kind of relation with the company. You should not be even shareholder of the company. So you have to make a choice before you apply for that. So these are the important recommendations that are done. Now, since time is short, and I would leave it now. I'll ask you if you have any specific questions, either on this quota committee recommendations or on the presentation that I have done so far. So I leave it to you now for your question and answer session. Though I wanted to close it by 12:15, but then even I am unable to finish off all my slides. So nevertheless, I leave it to you for open discussion. Now over to you.
Dear participants, if you have any doubts, you can ask now.
So I don't know, your silence doesn't give me any message.
I think no questions, sir.
Okay. All right. Whether they are shy of asking or they are tired of asking questions, I don't understand. Anyway, so thank you for your kind patience
Thank you, sir.
and also give me opportunity for joining university efforts in this important event of the conference. So especially thanks to Professor Vedava and all other faculty members with whom I had very close interaction. I visited your campus also. So in I think just before the pandemic period. Thank you. Over to you now for your closing remark. Over to you.
Okay, sir. Okay.
So can we leave?
sir. 1 minute, sir.
Yeah.
Hello, sir.
Yes.
I have one question, sir.
Yes, please.
Okay. Sir, you told, of course, external auditors are extremely important in ensuring the fairness of financial statements.
Mm.
But unlike other professions, say the profession of doctors or profession of lawyers, where the doctors or lawyers are directly accountable to their clients. But here, although they are recruited by or appointed by the management, their purpose is to protect the public interest, that is interest of the shareholders.
Right.
So now my question is, of course, you have mentioned various measures to see that the external auditors, protect the interest of the shareholders, like limiting their relationship with the management, rotating them frequently,
Yeah.
and all those
Yes.
things. But since these external auditors are appointed by the management and their purpose is to protect the public interest, to what an extent they can ensure the fairness of financial statement leading to corporate governance?
Yeah, that's right. But the external auditor is external auditor, and it is from the panel of auditors. It's not the company makes a choice on its own, but it's a panel which is approved by the professional bodies. And the fact that it is mentioned that the external auditor have to be on a rotation basis itself indicates that they don't have any kind of long-standing relationship with the company. So that means they are neutral to the interests of the parties outside the company, especially the stakeholders. And the second thing is that these are the professional ethics that they need to maintain, and we cannot insist professional ethics are professional ethics. And then any kind of deviation that comes in terms of reporting, and if the company subsequently after the statutory report audit report is done, if the company FI comes to limelight, then the statutory auditor's role will be taken into account. Even there are cases where auditors were also booked. So it is not that they get out of the responsibility once the statutory audit is done. And if the point is proved that the auditors were in knowledge, and if they are given any qualified opinion of the audited statements, despite the fact which is otherwise, so the statutory auditors are also booked, so they are not free. And similarly, even the independent auditor, in fact, independent auditor is supposed to work as a whistleblower, and this has happened in most of the cases. Independent director who is not party to the kind of statutory auditor, many times he is the one who works as a whistleblower for wrong things that are happening in the company. So this is where it is a kind of effort that needs to be done. Statutory auditors, yes, they are supposed to work in the interest of the stakeholders, not in the interest of the management. But at the same time, it is the professional ethics which are governed and at the esteem level by them. And they can't take any kind of risk of giving falsified statements and falsified opinions about the auditing, and they know that they are going to have future risk of their own career and profession by various monitoring authorities and also by the Ministry of Corporate Affairs. And the moment if any statutory auditor is found to be in collusion with any company in giving the falsified audit statements, then he loses his career. So they don't want to put their career at risk. Okay, so that's how it is only professional ethics with which they need to work. I hope I'm clear.
Yes.
Dr. Ramesh, good afternoon. Mallikarjuna.
Yeah, good afternoon. I'm sorry you have come to my rescue yesterday.
That's right.
I didn't know that you are also there.
Yeah, how are you? No, I joined.
Yeah,
I
good, good.
joined at 11 o'clock itself.
Okay.
Yeah, one of the issues that is being discussed in the governance circles is about the auditors' appointments. I think Dr. Vedava was also making a mention of this. Now, the regulators as well as the governing various committees that have been appointed, they are mulling over the provision of that auditors being appointed independent of the shareholders. Now
Yeah.
the shareholders are appointing, and usually the panel is proposed by the management only. And again, the remuneration is paid by the company. The debate now is, can that remuneration be dealing from the company? Can the entire appointment be dealing from, let's say, shareholders meeting and the panel being suggested by the management?
You're
How
talking
far do you think?
remuneration for the auditors you are talking.
Yes, remuneration for the
Yeah,
auditors and
yeah.
also appointment of the auditors.
Yeah, that's true.
Now, what could be the models? Because I think the biggest problem everybody is finding is who can pay the remuneration to the auditors and who can appoint. If it is government, there can be criticisms. So, according to you, what could be the remuneration model for the auditors and who could be the appointing authorities?
As far as my knowledge goes, and whether it is independent director or the statutory auditors, these are to be ratified by the regulatory bodies, especially the SEBI. The panel of experts which are done by the company which are forwarded, they have to be ratified by the regulatory bodies, and then also they have to be also under the panel as empaneled by the Minister of Corporate Affairs. For example, I have applied so many times, at least for 10 companies, to be an independent auditor. But then the company has forwarded my candidature, but then I did not get the clearance from the regulatory body. It happened in case of at least two companies. Now, the second point that what you are talking is about the remuneration. The remuneration has to be as per the provisions of the law. So it is not the company has any choice of limiting or giving the remuneration. If I am not mistaken, even there is a regulation in terms of the remuneration to be paid even to the directors of a company or the promoter of a company. As you understand, that it should not be more than 2.5% on 5 crores, whichever is the higher. That is the ceiling as laid down for the promoter of a company. And then it should not be more than 5% of the net profits of the company for all the directors of the company. So these are the regulations which are existing even for the auditors. So it is not a question of choice for the management of a company. These are as per the regulations. But as far as the auditors are concerned, I'm not still clear what kind of regulation or my way of looking at it. So I'm more looking in terms of their role to be performed. So I have not paid attention to the remuneration what they get. So in case if you have your idea, you may share on that.
No, the debate now is since the remuneration is linked to the company profits and also the incomes, that is the total income of the company, there is an incentive for the auditors to overlook certain things. The models have not been evolved. Even the people who are on the committees, various committees which are looking into this, they are trying to see how best this can be dealt. Right now, it is linked to the company's profits, company's total income, and company pays.
But again, as we said, it is a question of professional ethics. That's an issue about the
Yeah,
remuneration. Professional ethics should be at the highest esteem for all
yeah,
the auditors.
yes, correct, correct.
So in order to get a short-term benefit of highest remuneration, they can't put their own career at stake, by
Correct.
falsifying the audited statements of the company. So they are supposed to behave. So maybe that is one dark area on which still some kind of resolution has to be evolved. Just like as we have seen in case of directors remuneration. Similarly, directors also it is linked with the net profits disclosed. That 5% or 2.5% is also linked to the net profit. So they are also keen to enhance the profits of the company so that they get a higher pay. And we have a recent controversy of how it happened, where the SEBI has turned down the recommendation of one director. I don't remember the name of the company. That just a few days back, 10 days back, where the SEBI has turned out the board decision of enhancing the recommendation of company promoters. So the regulator is supposed to monitor them. But still, it's a dark area. It is linked with the profits, and that's where the there is a possibility of auditors being not honest enough to uh, keep track with the realistic situation of the profits of the company.
Yeah, thank you, thank you.
Yes, Professor. And once again, I'm thankful to you for coming to my rescue yesterday. I hope you are fine. Now you are still in that Central University, right? Professor Malkajinapur?
Yeah, I'm in Central
Yeah.
University of Kerala.
Okay, good.
Yeah.
So, any more questions before we close? Professor Vedav, are you there?
Yeah, sir. 1 minute. Gayatri ji, ma'am, have any questions?
No, sir, no.
Okay, okay.
Thank you, sir, for all the input delivered by you through this talk. I now request Dr. Parameshwara, Assistant Professor, Department of Commerce, Mangalore University, to propose vote of thanks.
Our privilege, wonderful presentation. Sir Ramesh sir, Ramesh sir has given
Your voice is low, sir.
Ramesh sir have given a wonderful lecture on financial reporting and how it is relevant to the corporate governance practices. Sir has given very good inputs and encouraged the budding researchers to take up research in the field of corporate reporting and corporate governance practices. Sir has explained the quality of financial statements and how reliable it should be and how honestly it should be presented to all the stakeholders. Along with that, what are the role the financial statement has to play in the minds of customers and how best it is to be presented to the external and internal stakeholders. As Sir has beautifully explained the misleading practices or in which areas the practices or misleading informations are communicated through 6 case examples and covering all the areas, the possible areas of errors and frauds. And as who has to take the responsibility of maintaining a good health of corporate reporting and enhancing good corporate governance practices. What role the management has to play, and what is the role of external auditors, and what is the purpose of audit report, and also explain the liabilities and responsibility of the auditor, and have given lot of suggestions how these practices or negative side of reporting practices can be resolved. Also given insight into the regulatory scenarios, highlighting key issues related to corporate governance and best practices report related to financial statement disclosure, financial statement reports. Sir, on behalf of Mangalore University and on behalf of Department of Commerce, Mangalore University, thank you for the wonderful presentation. We are really delighted. Researchers also happy about the inputs and the information they get for their future studies. Thank you very much, sir. And I thank Professor Mallikarjunappa, sir, and all the participants for making this session a wonderful one. Thank you very much. Thank each one of you again.
So thank you. Thank you. Goodbye to everyone. All the best.
Thank you, Ramesh. Thank you, Parmeshwar, and
Thank you.
everyone. Thank you
All the
very much.
best.
Sir,
Yeah.
Vedav sir
Yeah.
wanted to tell something.
Yeah.
Over to Vedav sir.
Learned delegates, uh, I may fail in my duty if I don't mention that the conduct or organization of this program would not have been possible without the suggestions, guidance given by uh, Professor Ramesh Sir, Dean, School of Management and Commerce, Mallar University, Hyderabad. So he has not only contributed in terms of becoming a resource person for our program, but also in terms of making this program, meaningful or successful. So we had a wonderful session other day on corporate governance landscape in G20 countries by Professor Kinari Thakkar. So that it is Professor B. Ramesh who suggested her name, and he arranged, in fact, it is Professor B. Ramesh sir arranged that particular wonderful session for us. And therefore, I once again, I thank Professor P. Ramesh sir for making this program moving or can say successful for whatever. So he has been a guide for the entire program. So yesterday when he expressed his inability due to some unavoidable reason, initially I felt somewhat nervous. Then when he told that he would take up the session today, I immediately felt very happy. Once again, I thank you very much, sir. Over to Ms.
You need to thank Professor Mallikarjuna for
Yes, sir.
giving me the opportunity to skip up my session yesterday.
Yes, sir.
Thank you, thank
I
you,
have to thank
thank
you,
you.
sir.
It's my pleasure. Thank you.
Okay. Okay, sir. I thank you, Professor Mallikarjuna, sir. Sir.
Thank you, thank you.
Thank you. Sir. Now over to Ms. Anushri.
Thank you. All the best. Can we leave now?
Thank you, sir. Dear participants, now we have come to end of morning session. Hope you all had a good time. I request you all to join the next section sharp at 1:50 p.m. Thank you.
Hello, sir. Siddiq, sir.
Am I audible to you?
Yeah, audible, sir. Audible.
Okay.
Okay, sir. Okay. Okay. Sana, sir. Am I audible?
Yes.
Okay. Okay.
Good afternoon, one and all. I welcome you to the second section of the day on Online Workshop-cum-Three-Day Conference Series 2021 on Corporate Governance and Financial Management, organized by Department of Studies in Commerce, Mangalore University. Without any further delay, let us begin with the session. I now request moderator of the session, Mr. Sanat Kumar, guest faculty, Department of Commerce, Mangalore University, to introduce the chairperson.
A very good afternoon to one and all who have joined this paper presentation session of the Online National Workshop-cum-Conference. I consider myself fortunate to have this opportunity of welcoming the resource person of the session, Dr. Abu Bakr Siddiq, Associate Professor, University College, Mangalore. A warm welcome to you, sir.
Thank you.
Sir is an associate professor and the coordinator of the Department of PG Studies in Commerce and the Department of MBA, University College, Mangalore. Sir has also served at FMKNC College, Madikeri, AIMSIM Bhatkar, and Padriya College, Mangalore. Sir has a teaching experience of 23 years. Sir got his MCom and PhD from Mangalore University. Sir is also an MBA with specialization in marketing. Sir is also serving as the coordinator of BCom correspondence course of Mangalore University. Sir has been recognized as PhD guide by the Mangalore University and he has been guiding 10 research scholars at present. Sir has been awarded with National Citizenship Gold Medal Award by GEPRA New Delhi for individual achievement in the field of consumer protection. Sir has organized several international and national conferences and workshops. Sir has presented papers on consumer-related issues in international conferences in Malaysia, Bahrain, Singapore, and Dubai. Several of them won Best Paper Award. Sir has written research papers on several ISBN and ISSN journals and edited books. Sir has also authored a plethora of books. Sir is also a member of editorial board of SIJM, an international journal of management. Sir is a member of International Association of Academicians and Researchers, Singapore. Sir is also a member of Consumer Education and Research Center, Ahmedabad. Sir is the coordinator of Bomb Pairing Study Fair, Mangalore University. Sir is serving in several other academic bodies of Mangalore University. Sir, we are waiting to hear your words of knowledge, intelligence, and lore. Now I request Dr. Abubakar Siddiq to kindly take over the session. Over to you, sir.
Sir, unmute your audio, sir.
Okay, thank you very much for your beautiful introduction. And I would like to know how many papers and how much of time is given to each presenter to make their presentation.
For today,
Can you hear me?
presenters, sir. 7 presenters.
Okay.
Time allotted is 5 minutes.
Okay. So we'll take up the questions later, and I would like to invite the paper presenters this particular session one by one.
Now it's time to start the paper presentation. Our first presenter is Trishant Kumar. Next, Shobha R. Please be ready.
Trishant Kumar, are you there?
All organizers.
Trishant Kumar, you are not audible.
Yes, sir.
Trishant Kumar, unmute your audio.
Yes,
And share your PPT.
technical errors.
And you can go to the next paper if when Trishant Kumar is getting ready.
Okay, sir.
Yeah.
Next presenter, Shobha R.
Yes, madam.
Yeah, Shobha, you are there?
Am I audible, sir?
Yeah. Please go ahead.
Whether my screen is there, you can
Yeah,
see
everything
the
is
screen, sir.
perfect. Yeah, everything is perfect. You are able. Please go on.
Let me start. Let me start, sir.
Yes, everything is perfect. You are audible. Your presentation is also, PPT is also seen. You can go ahead, please.
Thank you. Good afternoon to all. Respected chairperson of today's presentation, Dr. Abubakar Siddiq, sir, and my dear fellow presenters. I'm Shobha R, working as an assistant professor in Dr. G. Shankar Government Women's College, Ajarkadu, under guidance of Dr. Vedo P., the Chairman, Department of Studies in Commerce, presenting a paper titled Organizational Social Capital and its Effect on its Performance, a Theoretical Framework and Research Agenda. The purpose of this paper is to develop a conceptual framework in order to understand the impact of organizational social capital on its performance, taking organizational justice and employees' well-being as exogenous and endogenous variable. Methodology: the paper reviews the literature on organizational social capital and its impact on its performance and identifies research gaps. The underlying argument of this paper is organizational justice creates impact on social capital, which influences well-being of employees, which in turn creates impact on performance. Findings: the paper suggests ways through which different dimensions of social capital are related. This paper also extends the findings of organizational social capital research from an individual level to organizational level by proposing direct relationship with its firm performance. Let me concentrate on introductory part. Analysis of literature on social capital reveals that being a resource arises out of individuals or group network, social capital can create appreciable impact on performance of business organization. More specifically, social capital has been shown to influence organizational activities such as innovation, job satisfaction, research and development, human resource policy, successful investment policy, acquisition of finance, overall financial performance of organization, by locating the link between them not in the optimal organization of information flow, but rather in discouraging intra-organizational opportunities. Before understanding possible impact of social capital on organizational performance, it is necessary to understand the concept social capital and various dimensions in it. I'll just concentrate on concept social capital. The whole theory of social capital revolves around few concepts such as relationship between people, social network, benefit arises out of such social ties. All these aspects explains that very important adage in anyone's life is not what he or she knows, but who she or he knows. Present pandemic situation also taught to the entire world that do not be under assumption that what I know matters, but who you know shows way to live life comfortably. So next few slides are on literature review on concept social capital and organizational social capital, organizational performance, organizational justice, and well-being of employees. Let me move towards this slide. So where I proposed a model. So in this model, I considered organizational justice and well-being of employees as exogenous and endogenous variable, social capital as dependent variable, and organizational performance as social capital as independent variable and performance as dependent variable. Propositions: the above framework represent the proposed study relationship. The above framework represent the proposed study relationship between the aspects of social capital and performance, considering organizational justice and employees' well-being as exogenous and endogenous factor. Social capital is an independent variable, while performance is a dependent variable whose outcome depends on social capital. The hypothesis that can be drawn from the above conceptual framework are: social capital significantly influences organizational performance. Structural, relational, cognitive dimensions of social capital are interrelated and creates significant influence on social capital. Organizational justice creates significant impact on social capital at workplace. Organizational justice results in higher well-being of employee, which in turn enhances organizational performance. There is direct relationship exists between social capital and well-being of employees. Higher the well-being, higher will be the organizational performance. Only after coming out with various constructs under each four variable, model must be checked for reliability by using relevant statistical tool. Once it gets validated, it can be tested empirically. Conclusion and direction of future research. Based on extensive review and gaps identified, this study proposes to carry out further research among employees of commercial banks in Udupi. Proposed methodology: it is proposed that study employs both exploratory and descriptive research design and Some studies that were reviewed also used very small sample size. Hence, this study proposes to scientifically determine a representative sample size. An appropriate and representative sample size will thus be derived after establishing the population. The appropriate data collection tools would be both questionnaire as well as interviews. The questionnaire would have both structured and semi-structured questions to enable the researcher gain detailed information from the respondent, which was missing in some of the reviewed studies that solely relied on structured questions. Contextual proposition. From the extensive review, the study concludes that there is a relationship between social capital and performance. Contextual gaps have been identified in that research has been carried out among more established business settings. Consequently, this study recommends that a study be carried out among commercial banks in Udupi. Thank you, sir.
Madam, your presentation is over?
Yes, sir. Yes.
Okay, okay. It's a beautiful presentation and also it's an interesting topic you have taken up for this conference. I have a small question.
Yes, sir. Yes, sir.
What are the objectives of your study?
Objectives of my study is to understand the concept social capital and various interrelated factors in it. And the next thing is how to in what way social capital creates impact on organizational performance. Review of literature indicates that two variables are considered.
Okay, you just tell me the findings of based on these two objectives. What are the findings?
This paper is purely based on literature reviews, sir, and it's a proposal. Hello, sir.
But you have not taken any samples, and just we are mentioning in the methodology that you have.
This paper is purely a theoretical framework and research agenda.
Okay, okay. So I have a general question on the social capital. How an organization measures social capital?
Yeah, actually, when I went into various literature on the concept social capital, most of the literature says that it was studied under macro level. So, means for example, voters turnouts, number of agencies with an individual associated with it. So, such type of factors were considered. So, not workplace social capital was highlighted. So, my intention is to know how workplace social capital influences performance of the organization.
Okay. So is there any way to measure the performance of social capital?
Performance of social capital, sir?
Yeah.
So far, I didn't see, sir. Let me search about it.
So how actually you measure the performance of social capital? Okay, you can say that you have a social capital, but what is the way in which you can measure the performance of social capital?
Yes, there are three dimensions in it: relational, structural, and cognitive. So I can measure social capital taking into consideration various aspects associated with those three dimensions, such as trust, shared value, shared visions, cooperation, flow of information.
So is there any quantitative measurement?
There is no quantitative measurement so far, sir. It is purely qualitative aspect.
So it is not depicted in the financial statements of an organization. If I look at the balance sheet, can I have something which is related to social capital or performance of social capital or about the social capital in a particular organization?
So far, it was not done in banking sector. Because they study only social capital and stability of banking sector. One or two papers are there on performance where the objectives are not that much clear. So that's why I thought let me have a study on it.
Okay. Okay. Thank you, madam. Thank you very much.
Thank you very much.
Okay. Next.
Next presenter, Krishant Kumar.
Yes. Am I audible, sir, now?
Yes, very clear.
Okay, sir. Good afternoon, organizers. So I am going to present the paper on transfer of learning and its impact on employees' job performance in IT and ITES sector. So here, whatever I have conducted my research study throughout the Karnataka for my research, but here I have taken that only a few cities. Okay. But for this, study especially, I have taken only Mangalore city, and the basic introduction goes like this. During the last 10 decades, in the training and development field, it has seen rapid changes and still continues experiencing them in its headlong rush to keep up with the evolutionary process of adoption to an ever-changing world and its ever-changing technology. So basically, what we have going to learn the lot of new concepts. Mainly when we go to the company or when we go to any training institutions, we learn a lot of new concepts, new ideas. So my study inculcates or gives the information about. So whatever we learn, are we in a position to apply the new knowledge in our organization? Once we come back from training institutions, are we in a position to apply the new knowledge? So transfer of learning refers to the process of transferring the competencies acquired in the plan of training to the workplace both effectively and efficiently. It means the degree to which what I said just now, are we in a position to apply to their job to job the knowledge, skills and behaviors learned in the training. So main objectives here mentioned: impact of transfer of learning on employees' performance, the impact of training transfer on organizational productivity, the impact of training on employees' satisfaction, the need of employee training in an organization. So this is the main objectives which I have framed. And on that base, so the methodology here, whatever I have selected only 30 companies, 30 respondents. 30 respondents from 5 companies in and around Mangalore city. Okay. So out of it, to mention the few companies name Infosys or Emphasis or Cognizant and the Winman Software, IT and ITES professionals, IT and ITES employees or specialists. Okay. And whatever the data collected, I have framed analysis and results directly. So on that base, I have asked a few questions on the base of the training which I have taken, as well as are they in a position to apply the new knowledge, or companies are giving proper information or training, or just namesake. At the same time, whatever the company spends for each employee for their training, so is it a expenditure or income for the company for the in a long term? So to understand that, the analysis part, the training program is compulsory for the employees for better performance and productivity. Here, more than 65% of the respondents believe that the training program is compulsory for their performance. To improve their performance and to improve their skills also, the training is very much important and compulsory also. Might be seen that once in a 3 months, 6 months, the company gives training to their employees to improve their knowledge. At the same time, what are the new knowledge, especially in IT and ITES sectors, we know very well, updation of knowledge or softwares as at the same time the new versions. So for that sake, it is compulsory for IT and ITES employees. And whenever we ask the questions, the transfer of learning has positive influence on their job performance. So here, more than 60% of the employees again strongly agree with that, because so it definitely improves their performance, as we know very well in our any field. So in that respect, definitely it influences on their employees' performance. And the third one is training has high influential impact on employees' performance. So again, we could understand with the help of this, 66% of the respondents strongly agreed with the statement, and the few employees not at all agreed with this. So when we go to the next findings, the training content. So here, whatever they apply the knowledge, especially on the job or off the job training, so the knowledge which they are applying. So when we understand that, the 62% of the employees are find that the training content was good to apply the new knowledge, because there are cases we are lagging behind with that old knowledge, old things. As we all know that NEP also, which gives the new informations, at the same time here also training which they are giving, and it should be suitable to their company's job performance especially. It should not be like simply the namesake or giving the certificate to them. So for that sake, what they said, the training content was good to apply the new knowledge. And when we are asking the question, the type of training received on the job or off the job, a majority of the people say that on the job, because when they are performing their job or duty, their itself given training is more valuable and good. So on that base, 66.67% of the employees expressed on the job training the directly affect on their performance. And when we are asking that question, the next one, receiving training from the organization to improve performance and productivity. Of course, we can understand also it improves the productivity, it improves their knowledge, skills, and everything. And lastly, training has positive impact on employees' performance. Again, 64% of the believe that training has definitely positive impact, and they give more companies also give more weightage for such trained employees also. And lastly, the training program helps to create job satisfaction. That is very important. Work-life balance. What we say, especially job satisfaction or quality of work life. 64% of the respondents believe that training program definitely creates job satisfaction. Whenever a company conducts or gives proper training relevant to the present scenario, definitely it improves their job satisfaction and the quality of work life also. By concluding saying that HR department is constantly recruiting talented individuals from wide market and subsequently provides training to manage global problems. Through different HR activities and training programs, inciting workers to utilize the new acquired abilities. That's what I highlighted here. Whatever the new knowledge they acquired, are they in a position to apply into their real life picture or the job? They keep talent within the organization and ensure career path for performers to accomplish more efficiently and effectively. Thank you, sir.
Okay, Trishwan Kumar, finished?
Yes, yes.
Okay, it's a good presentation, and you have taken a very broad area, taking care of performance, productivity, and satisfaction, and ultimately your study is finding out the impact of transfer of learning on job performance, right?
Exactly. Yes, sir.
Yeah. And Trishant, I have a couple of questions. What are the variables you have taken to conceptualize learning?
Pardon me, sir?
What are the variables you have taken to conceptualize learning, and what are the variables coming under learning for the purpose of your study?
Especially we were conducting IT and ITS aspects, the independent variables and independent variables. In that independent variables, whatever the company is giving training, and the dependent variables, whatever we gain out of that, okay, or what we are applying the new knowledge, that is the outcome of that. That is the dependent concept.
So you have taken only training.
Tell me, sir.
Yeah. Transfer of learning. So transfer of learning, you have taken only training part.
Yes, training part only.
Okay. So only one variable you have taken, and you have seen what is the impact of this training on the performance of jobs, right?
Yes. Are they in a position to apply new knowledge, or simply they're good for the training, or companies spending so a lot of amount for their training, or the expenditure, or the long in a
Yeah. Okay. Am I audible to you?
Yes, sir. Tell me.
Okay. And you have taken performance, productivity, and satisfaction. And how actually you measure the productivity of an employee, from the point of view of transfer of learning. With reference to transfer of learning, how do you measure the productivity?
See, once we understand when we ask a question with post a question with those people or employees, so before 2 years or after 2 years, how they were and how they are now, or by improving their skills or the talents or the abilities to apply the new knowledge, and company gives more importance for such employee, and with the help of that, the productivity also improves, and those employees getting more weightage in that company as well as demand from other organization also.
Okay. So what is the way you have asked the questions? Because
directly, Yes, with the help of Google Form, I have framed the questions and I just posted through mail and asked the question. And there are
Like
cases it's
what
confidential,
like
I'm not giving. Tell me, sir.
what is the scale you whether you have used Likert scale?
Yes. 5 scale, Likert scale we used, especially highly satisfied or the satisfaction level to understand that.
So
And
productivity, productivity, performance, and satisfaction. All these three things are measured on the basis of their responses for your questions.
Exactly, sir.
Okay. So any quantitative measurement?
Yes, I am doing my research on that. So I have taken few little in that only. Just I have given this information. A lot of informations are there, and especially now, for the further research also, what we are understanding. Before what we have seen only companies sponsoring training, and after that we have seen that okay, in-house training or outbound training or off the job. But now, more interestingly to understand, employees only self training concept. That is a new concept which coming up, and a company gives more importance for such employee. You should learn and you should practice. Okay, so company
Okay. So
doesn't spend much money for that.
yeah. Final question for which I expect one word answer. What is the impact of transfer of learning on job performance?
It improves their skill, knowledge, and talents.
Okay. Thank you, Trisan Kumar. Thank you.
Thank you.
Okay. Next.
Next presenter, Akshata Suvarna and Prasanna Kumar.
Afternoon, sir.
Yeah, good afternoon.
My PPT is visible, sir.
Yeah, it's visible. Please go ahead.
Am I audible?
Yes, very clear.
Okay, sir. Good afternoon, everybody, the chairperson and fellow participants. I am Akshata Suvarna, assistant professor in GFGC Halayangadi, and today I'll be presenting a paper on the performance evaluation of mutual fund. And the title of the paper is Impact of COVID-19 on the Performance. 1 minute, sir. I have not shared my PPT.
Hello?
Yes, sir.
Your PPT is not visible.
Yes, sir. So that was a Word file. Now I have shared my PPT.
Okay.
Yes, it's visible. Yeah.
So the title of the paper is Impact of COVID-19 on the Performance of Mutual Funds, an empirical investigation of selected large cap equity schemes in India. And this paper is co-authored by Prasanna Kumar, assistant professor in GFGC, Haryangadi. Now, as we all know, the world is facing an unprecedented health crisis as a result of the spread of COVID-19 with far reaching economic implications. Now, especially in the initial phase, with the spread of COVID-19, corporate processes were disrupted and demand for products and services also were disrupted. With both demand and supply shocks, the COVID 19 outbreak had paralyzed global economies and several financial markets had fallen by up to 20% from their 1 year high. Now, as soon as talking about the Indian economy, as soon as the illness spread in early March, India instituted one of the toughest lockdowns in the world, severely disrupting economic activity. Now, the current pandemic crisis had a significant negative influence on Indian businesses. With a deterioration in market sentiment, pandemic had a negative impact on financial markets, and the mutual fund sector is no exception. Now, as a result of the turbulence, the volatility, the mutual fund industry had also experienced extreme volatility. So, in this present study, an attempt is made to investigate the impact of the COVID-19 on the performance of the large cap mutual funds. Now, talking about mutual funds, the risk averse investors, they choose to invest in funds because they can have their portfolio managed by a fund manager for a fee. Now, especially during the crisis period, it is very interesting to know how the funds have performed. So, when compared to individual equities or passive indices, actively managed funds, they are expected to demonstrate superior performance, especially in the down market. Now, particularly in times of crisis, investors would expect actively managed funds to outperform at least their benchmark. So they expect the fund managers to work harder in periods when investors need them the most. Now, due to the COVID-19 pandemic and the resultant lockdown, the year 2020 turned out to be one of the most volatile periods for the equities market. The majority of the financial markets had experienced circuit breaker suspensions and volatility had reached record heights. So, this makes it both interesting and timely to examine how the changing situation of COVID 19 has influenced the fund's performance. So in my study, I have taken a sample of only the large cap mutual funds. The impact of the crisis on mutual fund performance at various stages of the crisis compared to the pre-crisis period. So here in this study, I have made a comparative analysis of the performance during pre and post-crisis period, that is post-COVID period. So that would provide significant insight into asset allocation decisions during times of extreme market volatility. That is how the funds have performed. So the present study is an attempt to investigate the impact of COVID-19 on the performance of large cap mutual funds. Now, the large cap mutual funds, as we all know, are equity funds that invest a greater proportion of their total assets in companies with a high market capitalization. Now, why particularly these large cap funds have been used in this study? When you talk about large cap companies, these companies are well known and have a proven track record of creating money for their investors over time. Because these schemes invest in financially strong large cap companies, the general belief is that they can endure a market downturn. So I wanted to see whether that really happened. So therefore, it will be very interesting to see how resilient these funds are in the face of the pandemic. Therefore, in this study, only actively managed equity large cap funds are considered for analyzing the performance of these funds during different phases of the pandemic. So in my study, I have taken a sample of 18 open-ended large cap equity mutual funds. The performance has been evaluated for a period of 3 years, beginning on July 1st, 2019 and ending on June 30, 2021, which includes, so I have taken this study period in such a way that both pre-COVID as well as post-COVID period is included in this. So each of the selected large cap funds was evaluated using widely accepted tools and techniques for evaluating equity mutual funds. Like we have the rate of return, risk adjusted rate of return, the measures such as Sharpe and Trainer measures, and also the Jensen measure, which is used in evaluation of the stock selectivity skills of the fund, that also has been used in evaluation of the performance of these mutual funds. Now, the objectives, I have here the four important objectives. The intention is mainly to evaluate the impact of COVID-19 on the performance. So the specific objectives are to examine the impact of COVID on the rates of return generated by the large cap equity mutual funds, to analyze the impact of COVID-19 on the performance of selected large cap equity mutual fund schemes on the basis of risk adjusted performance measures, to examine the extent of diversification of equity mutual funds during pre and post COVID period, and to assess the stock selectivity abilities of fund managers during pre and post COVID period. Now, the scope of the study is limited to the sample of large cap equity mutual funds for a period of 3 years. And as we know that mutual funds, we have the dividend and growth options. So in my study, I have included only those funds where we have this growth option. And in mutual funds, we have regular and direct schemes. I have included only the regular schemes for my study. Now, schemes launched before June 2019 are included in the study period. So, the inclusion of the schemes in the sample is based upon the availability of the necessary data. That is, only those schemes which have been launched before June 2019, because I wanted to have the data for continuously for all the 3 years. So, I had included only those schemes which was launched before June 2019. Now, for analysis of the impact of COVID on the performance of the mutual funds, the study period of 3 years is segregated first into pre-COVID period and post-COVID period. And especially the emphasis is on the post-COVID period. So, post-COVID period, to have a detailed analysis, post-COVID period is once again segregated into two sub-periods, that is from 20th February 2020 to 4th November, and sub-period 2, that is considered as a follow period, which starts from 20th February to 4th, sorry, this is from 5th November to June 2020. Now, how exactly this date is identified? Now, in my study, I have taken the NSE index, a total return index, as the benchmark. So, this total return index is also used in identification of the crisis period. So, as I have already told you, the post-COVID period is segregated into two sub-periods. That is, we have the period of extreme volatility, that is considered as the crisis period, and then we have sub period 2, that is the follow up period. So we can to identify the dates, the study period of 3 years from June 2019 to June 2021, period from 20th February 2020 to 4th November 2020 is taken as the crisis period. February 20th is taken as the starting date of the crisis period because the stock market peaked on February 19 before its rapid descent. So from February 19th, we have a downward trend that can be seen very clearly in this graph that I have presented. So the impact of the COVID-19 from February 19, there is a sharp decline, the downward trend, and then there is a recovery. So February 19th, February 20th is taken as the starting date of the crisis period because the stock market peaked on February 19th. The closing index, that is total return index on 19th February, was 17,024, followed by a sharp decline in the index for the next 4 weeks, reaching a lowest index value of 10,710.41 on March 23rd. So we have here the lowest point, that is on March 23rd. So this period is taken as a crisis period because it had reached such a lowest point. And then November 4th is taken as the ending date. So this crisis period starts on February 19th and it ends on November 4th. November 4th is taken as the ending date because on this date, market largely rebounded. So on 5th November 2020, the index value once again reached the level of 17,000. The exact value of closing index being 17,189. So on this basis, by taking the NSE index, I have identified 3 different periods, the pre-COVID period and the post-COVID period, that was once again segregated into 2 sub-periods, the crisis period and the follow-up period. Now the data sources have taken the NAV that is taken from the ANFI website. NSE total return index is used as a benchmark, and data on NSE total return index and 91-day treasury bill, which is taken as the risk-free rate, is taken from the RBI website. So this is the sample that I have included in my study. There are 18 large cap schemes included in this study. Now, first, the return and the risk of the selected equity mutual funds. Hello, sir.
Yeah, you are audible. Please go ahead.
Okay. My PPT is visible, sir?
Yes, yes, yes.
Okay.
Now, talking about the return, so the first important thing that is used in the analysis is the return that is generated by these mutual funds. Now, what I found is the daily return. So, this is the research methodology that is used. So, daily net asset values are taken to calculate the return, and I have used the log return, that is a continuously compounded return, log return. And then the risk is being analyzed by taking the standard deviation and the systematic risk, that is the beta values, have also been computed in this study. And we have the diversification, the R square, that is used in the evaluation of the diversification. And we have risk adjusted measures such as Sharpe ratio and the Trainers ratio used in the study. And then Jensen measure, this is to evaluate the stock selectivity skills of the fund. Jensen measure is used. Now, this is the summary of the important findings. So, I will take each one of that. First one is the rate of return. Now, in the case of the rate of return, I have a separate analysis that is presented for pre-COVID and a post-COVID. So, in the pre-COVID period, the performance is good. That is almost all the schemes except one scheme, that is HDFC, large cap fund. All other funds that have been analyzed has given a positive average daily return. But when we take up the crisis period, that is post-COVID sub-period 1, all funds recorded negative returns. So that is because of the the COVID impact can be seen very clearly in this post-COVID crisis era. All funds recorded negative, indicating the detrimental effect of COVID on mutual fund performance. Now, when we take up the post-COVID sub-period 2, that is the follow-up period, all of the schemes had positive average daily return. Now, analysis of returns pre-COVID. In the pre-COVID phase, what we do is see always the mutual fund, the fund, how they have performed, that can be analyzed by comparing its performance with the benchmark. So each fund has been evaluated by comparing with its own benchmark. So the benchmark comparison has revealed some of the important things here. As you can see on the table, we have average daily return, and we have the data as to how many funds have outperformed and how many funds have underperformed their benchmark. And especially in the crisis period, the performance is very important even from the investor's point of view. You can see in this table, in the pre-crisis period, out of 18 schemes that are considered, 14 have outperformed, and only 4 schemes have underperformed their respective benchmarks. But in the crisis period, there is only one scheme has outperformed. What I found is in the crisis period, all the funds had a negative return. So they were not able to generate even the risk-free return. That is, in the crisis period, if the investors had invested in the risk-free investment avenues, they would have got better return. But what is important for us is the comparison, in comparison with the benchmark, how these funds have performed. And it is very disappointing to note that only one fund has outperformed the benchmark index, and out of 18 schemes, 17 funds, that is about 94%, have underperformance. Okay, they have underperformed their respective benchmarks. But in the post-COVID, we have the performance has improved. There are 6 funds have outperformed their respective benchmark, and underperformance was reported in the case of 12 schemes. So when we compare with this follow-up period, sub-period 2 with the pre-COVID, once again they have not reached their pre-COVID level performance. So analysis of return post-COVID during the post-COVID sub-period 2 phase of the study period, despite the fact that all mutual funds produced positive returns, 12 schemes continue to underperform the market index, while only 6 schemes outperform the market index. So this demonstrates the mutual fund's inability to match its pre-COVID era performance levels. Now, comparison with the risk-free rate of return, as I have already mentioned here, during the pre-COVID study period, 16 funds had a higher average daily return than the risk-free rate of return of 0.014. performance has deteriorated post-COVID, with the negative returns preventing any of the funds from earning returns higher than the risk-free rate of return in the post-COVID sub-period 1. However, as performance improved, post-COVID phase 2 returns were higher than the risk-free rate of return. Now, taking up the risk analysis, I have calculated the standard deviation and the beta values. The total risk, which includes both systematic and unsystematic risk, is measured by the standard deviation. A higher standard deviation indicates that the returns are more volatile and dispersed, as well as a riskier portfolio. So, in my study, what I found is in the pre-COVID study period, 14 of the 18 schemes had a standard deviation lower than the market index, implying that they assumed less risk. A total of, now talking about the post-COVID period, a total of 16 schemes had a lower standard deviation than the market index during the post-COVID 2, that is follow-up period phase. But it is very interesting to see how the funds have performed in the crisis phase. So there is something good about the funds, that is in the crisis phase, when all of the funds have been evaluated in this analysis, had a lower standard deviation than the market index standard deviation. So this indicates that mutual fund returns have been more consistent in comparison to the market index throughout this turbulent period. Now beta, taking up the beta values of all the mutual fund schemes were found to be positive, which is an indication of the fund's performance closely following the market's return. In the pre-COVID period, all of the schemes had a beta of less than 1, with the exception of 2 funds. However, during post-COVID, both the phases, all of the funds considered in this study had a beta less than 1. So a beta of less than 1, that is what I have found here, indicates that mutual funds portfolio are less volatile than the benchmark. Now, next important thing is the diversification. So for equity diversification,
Yeah, please go through important slides.
Okay. So in both the pre-COVID and the post-COVID sub-period, all of the schemes had a R-square value of more than 0.8, indicating that these mutual fund manage well-diversified portfolios. Now, Sharpe's ratio, there is one important thing that I would like to tell here in the case of risk-adjusted measure, that is considering the Sharpe ratio and trainer ratio, especially in the crisis period, almost all the funds, that is, we have 18 funds have underperformed the respective benchmark. So none of the funds could beat the market in the crisis period. So that is one important observation that has to be made. Now, considering the stock selectivity skills of the funds, I have used the Jensen measure. So the data that is presented here, it reveals that majority of the large cap mutual funds, that is 14 out of 18 funds, that is about 78%, have posted positive alpha values. So this indicates that fund managers have exhibited superior stock selection abilities during this phase of the study period. So although a large number of the sample mutual funds had positive alpha, a significant alpha value at 5% level of significant was noted only in respect of 4 mutual funds. So alpha values for post-COVID sub-period 1, negative alpha values posted by all the mutual funds are indicative of poor stock selection abilities. So all the funds had negative alpha values. And during post-COVID sub-period 2 study period, significant number of mutual fund managers have shown positive alpha values. 13 out of 18 funds have posted positive alpha values. So as a conclusion, I would like to say that the pre-COVID performance was good, but especially in the crisis period, the investors would expect something from the mutual fund managers, but that has not happened. So during post-COVID sub-period 1, funds have not performed satisfactorily, and majority of the funds failed to outperform the market index. So, but post-COVID sub-period 2, there is improvement in the performance. So the mutual funds need to improve their performance, especially during the crisis period. They have to use their professional skills and they should try to generate returns, okay, that is expected by the investors. So that's it.
Yeah, okay, yeah, Akshat. So it's a very good presentation, and your effort must be appreciated. You have conducted a very good study, timely, and methodology followed is also very good. I have one or two questions, and you have compared the measurement of mutual funds
Yes.
during pre-COVID as well as post-COVID. And you have concluded that the performance of these mutual funds pre-COVID is better than the post-COVID, right?
Post-COVID. And post-COVID, especially, my focus was on crisis period. See, when the market is volatile, investors, like on their own, they does not know how they have to invest. So they usually take the help of the fund managers, right? So the crisis period performance is not that good.
Good. Okay. Okay. So how do you say that? How can you say that specifically? The post COVID performance of mutual fund is not good. Is it? How do you know that it is only because of COVID-19?
No, crisis period is, we can see the impact of COVID. As I have shown on the graph, there is a sharp decline even in the index values, right?
No other reasons.
No, there is like.
Okay. So based on your study.
Yes.
Yeah.
Yes.
How do you say that it is only because of COVID-19 and no other reasons, or do you have some other reasons that is also responsible for the poor performance of this mutual funds?
No, in the post-COVID, because I have segregated two important periods, right, sir? So the performance is different. And I would say that it is mainly because of the COVID, especially in the crisis period.
You have any statistics, any data, any tests?
No, it is the technique that I have used. I have used the same technique even in the pre-COVID period, and I see that the performance is different. So there could be some other reason, but that period, crisis period, it is mainly because of the COVID-19.
Okay. What is your suggestion to improve the performance of mutual funds during post-COVID period?
Okay. See, what we have in the mutual fund is there is a passive index. See, I have taken in my study the actively managed funds. And when we take up the actively managed funds, you know that the investors have to pay additional fees, right? Fees, okay, for whatever the services that they avail. Now, when they pay additional fees, they also have some expectations, right? So, if they had invested in the passive or index fund, they would have got better return in the crisis period. So, especially in the crisis period, the investors want the professional skills of the fund managers. They expect something from the fund managers. Crisis period, especially in the crisis period.
Okay,
So,
madam, it's okay. We'll conclude. Okay, it's a good presentation. Thank you. Yeah, next.
Next presenter, Dr. Sumit Kumar and Mukhtar Hussain.
Hello, sir. Am I audible?
Yes. Yeah, please.
Okay.
Dr. Sumit Kumar?
Yes, sir.
Yes.
My name is Mukhtar Hussain.
Yeah, your screen is visible.
Okay. Okay, sir. Good afternoon, all the respected teachers and presenters. My name is Mukhtar Hussain. I'm going to present my paper entitled as Inter-District Variation in Financial Literacy and its Determinants Insight from West Bengal. Sorry, sir, my system is not responding properly.
But you are audible to me.
Okay, sir.
Your screen is also visible. You are also audible. Please go ahead.
Okay, sir. So, coming to the introduction point, financial decision making has gradually become a complicated process, especially with the emergence of new financial products and services and increasing in the complexity of financial system. Therefore, the possession of adequate financial literacy is point essential to empower the individual in making prudent financial decisions and participating in the financial system. The pivotal role to be played by the financial literacy in
Please
increasing
quote your
the
objectives. Please quote your objectives.
okay, sir. Objective of the present study is to assess the inter-district variation of financial literacy in West Bengal and to investigate into the antecedents of the level of financial literacy of the people belonging to different districts of West Bengal. Now, coming to the data source of the study, for the purpose of this study, secondary data has been used in order to reach its multiple objectives. The secondary data regarding different dimensions of financial literacy, that is financial knowledge, financial behavior, and financial attitude, were collected from financial inclusion insight database. In addition, the data regarding the number of available banks in a particular district has been collected from Economic and Political Weekly Research Foundation India Times Series database. The number of population of the district has been collected from the report of census 2011. Now coming to the methodology of the study, the present study selected the questions and response towards the financial knowledge, financial behavior, and financial attitude of the respondent of 19 districts of West Bengal. OECD, that is the Organization of Economic Cooperation and Development, International Finance Network uh, on Financial Education toolkit was followed for identifying such questions on financial knowledge, financial attitude, and financial behavior to eventually arrive at the financial literacy score of an individual. 5% were selected for financial knowledge, 2 questions for financial behavior, and 3 questions were asked in the domain of financial attitude. Now, with respect to each and every question associated with the financial knowledge, financial attitude, and financial behavior, there is one for the right or desired answer. If the respondent give the right or desired answer, he or she is awarded 1 mark, otherwise 0. Finally, the financial literacy score of an individual is obtained by summing up the scores obtained under financial knowledge, financial attitude, and financial behavior dimension. The average of the percentage of the score obtained by the respondent is respected to financial knowledge, financial behavior, and financial attitude is taken as the financial literacy score. Any score of the 75% or above is denoted as a high financial literacy. Score of 50% to less than 75% is regarded as moderate level of financial literacy, and the score less than 50% is marked as low level of financial literacy. In the second stage of the study, the demographic and socio-economic determinants of the financial literacy for the advanced as well as backward district uh, are determined using the central public education model, which is also substantiated by Wales model in order to test the consistency generated of the result generated by Wales model. And now, this is the detailed description of the variables used in this study and the expected relationship of the dependent variables with the financial literacy score are presented in this table. It will be of special interest to check whether the actual relationship conforms to the theoretical relations or not in this study. Under the underlying rationale of the expected relationship is driven by the theoretical proposition put forwarded in the literature and are discussed in details while discussing the outcomes of the study. Now, this table describes the demographic and socio-economic variable of the respondents belonging to advanced district as well as backward districts and the financial as a whole of the respondent. And the table shows that out of the total 3,539 responded, uh, 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 2,972 were married, and 1,007 had no formal education, and 1,460 had primary education, and 826 of the respondents have secondary education, and only 191 respondents have higher secondary education. 55 of the respondents had higher education, possess higher education. Out of the total respondents, the study shows that the 1,896 respondents were female, and falling to the age group of 15 to 24 years is 710 respondents. 860 respondents were to be falling in the age group of 25 to 34, and 777 of the respondents had the age between 35 to 44 years, and 568 of the respondents were having the age between 45 to 54, and finally the 624 of the respondents have the age or above 55 years. Out of the total respondents, that is 183 of the respondent does not own smartphone, and uh, 265 respondents they are located in the rural area, and uh, 400 of the respondents who does not have enough money for their foods, and 1,268 respondents have only the money for their food, but they not afford to buy their clothes. 1,620 respondents were found to have enough money for their food and clothes, but they do not uses the money for their highly luxurious goods, and only 211 respondents were having the enough financial capability. Now, coming to the next slide, that is the level of financial literacy in the West Bengal. The outcome of the study highlighted the dismal state of financial literacy in different districts of West Bengal, irrespective of their condition in terms of the access to the financial service or not. Low level of financial literacy was evident in 15 out of 19 selected districts. Financial literacy level of the participants of Kolkata, Howrah, and Paschim Midnapur were found to be medium. Astonishingly, respondents from none of the districts were found to be possess high level of financial literacy. This is the determinant of the financial literacy, and it shows that age of the respondents belonging to every region of the study were found to be positively correlated with the financial literacy, where age square is negatively associated with the financial literacy. Marital status of the respondent have a positive impact on financial literacy, but it is not significant, and the level of education of the respondent are positively affected the financial literacy, whereas gender gap has also plays a positive implication on financial literacy. Technological aptitude are found to have positive association with financial literacy. The location of the respondent also found to have positive and significant uh, association with the level of financial literacy. Finally, the financial condition of the respondent positively impacted to the financial literacy of the respondent. In the next slide, the similarity presentation of the determinants of financial literacy are presented, and the table shows describe that uh, age, education, gender, technological aptitude, location, and financial condition uh, are statistically notable determinants of financial literacy of the respondent belonging to the state of West Bengal. Empirical literature suggested that age is an important determinant of financial
Yeah,
literacy.
please conclude. Please conclude. Mukhtar Hussain, please conclude.
Oh, the financial literacy is a point essential for the financial well-being of an individual and the present in the present scenario for maintaining a good and standard life in the present and to secure the future. The importance of financial literacy can never be undermined. Financial literacy is a multidimensional concept consisting financial knowledge, financial attitude, and financial behavior. The present study highlights the state of financial literacy among the people of West Bengal, India, and its determinants using the financial inclusion insight program database. The outcome of the study revealed low level of financial literacy among the people in advanced as well as backward district and the West Bengal as a whole. Out of 19 districts, only 4 districts, Kolkata, Howrah, Tirupur, both exhibited moderate level of financial literacy. The outcome of the study suggested the existence of notable variation in the level of financial literacy in terms of various demographic features, which later were found to be important determinants of financial literacy. Analysis of the result of the study indicated that level of education, age, and technological aptitude, location, financial condition were found to be exacerbating a significant positive effect on the level of financial literacy. Gender gap was noticed in terms of financial literacy among the respondents, which shows that women were lagging behind the men in terms of level of financial literacy.
Okay, Mukhtar Hussain, it's a good effort. And I have one or two questions. And totally you have selected 19 districts, right?
Okay, okay, sir.
In
Yes, sir.
West Bengal. So what is the basis for selection of these 19 districts? On what basis you have selected these 19 districts?
Here, sir, data has been collected.
Sir, this is Sumit Kumar Maji. Can I respond? I am the
Yeah, yeah, please.
Sir, there are 19 districts and all the districts were selected. Actually,
Ah.
yes.
Yeah, please.
Data for all the districts were available, so all the districts were chosen for the purpose of this study.
Okay, okay. Now you just tell me what are the main two reasons for the variation in financial literacy among these states districts?
I'm sorry, sir.
What are the main two reasons for the variation in the financial literacy?
Okay, sir. Sir,
Yeah.
sir, the variation, reason of variation between the district is a different dimension of financial literacy. That is financial knowledge, financial behavior, and financial attitude. Some specific district possesses high level of financial knowledge, but their lack of financial behavior and financial attitude. And the study exhibiting that financial attitude and financial behavior are totally zero. So this is the main reason of variation among the district.
Okay, what are your suggestions?
Sir, the suggestion I will want to recommend that the people will the financial behavior level of the people will be increased and the basically women of the state will be emphasized in order to enhance their capability in terms of financial literacy and financial education. And financial literacy should be added as a subject in the curriculum of educational institution so that from the beginning of the life, the individual is aware about the financial goods, financial products, and financial services, and how to efficiently manage and operate with such complex financial instrument. These all
Okay. Yeah. Okay. Thank you. Next.
Next presenter, Datta Kumar.
Good afternoon, everyone. Am I audible, sir?
Yes. Yeah, please go ahead.
Good afternoon, sir. And good afternoon to the organizers, participants, and the paper presenters. And I wish all of you a very happy Ganesh Chaturthi. I am sharing my 1 minute. Sir. Is my screen is visible, sir?
Yeah, no, it's not visible.
Not visible. Not visible, sir.
Yeah, now it's visible. Yeah, please go ahead.
Yeah, okay.
Now it's visible. Yeah.
Thank you, sir. The topic for the presentation is rural infra. Visible, no, sir?
Yeah.
Training tour of Karnataka. So I am Datta Kumar, the research scholar, University College Hampanampeta, Mangalore. Yeah, okay. Yes. The introduction. The increasing concern with social aspects of development finds its roots in the realization that a unit of investment in education, health, social welfare, or other branches of manpower planning is in the long run as productive as unit of investment in equipment. Provision of health facilities is required of all human beings. The health concept not only includes freedom from communicable and yes, sir.
Yeah, please go to your objectives, methodology, findings, conclusion.
Not audible, sir. Okay.
Please go through your objectives, methodology, findings, and conclusion.
Okay, sir. The objectives of the study are mainly, there are two objectives: to know the various government schemes pertaining related to rural health sector and to analyze the funding of government to rural health sector and the various government schemes and the methodology of this study. This paper attempts to evaluate the funding of government towards rural health sector of Karnataka. This study also tries to find out the availability of medical facilities to unity of Karnataka and the extent to which these facilities are utilized by the rural community. Secondary data is collected for this study to know the impact of availability of medical facilities on the development of rural health sector. Government funding for various health schemes and the number of beneficiaries for there are so many government schemes introduced by the government of India as well as government of India for controlling malaria, for controlling dengue, and they have allocation of funds, percentage of utilization. Beneficiaries of health programs in Karnataka. There are so many programs introduced by government of Karnataka, Prasuti, RIK, Madilu, Tai Bhagya, Janani Suraksha Yojane, Rashtriya Bala Swasthya Karyakrama, Arogya Kavacha, dialysis, telemedicine, burns cases, and extended Tai Bhagya. The total benefits taken from 2013-14 to 2018-19, more than 1 crore beneficiaries in Karnataka. To conclude, central and state governments have come up with many health schemes for rural health sector in order to develop healthy rural community. In this paper, various government health schemes and funding to rural health sector are analyzed. The analysis showed that more than 1 crore rural people have taken the benefits of rural health schemes. In case of malaria, financial progress in rural areas when compared to funds sanctioned, more than 100% expenditure made in the year 2016-17. Rest of the years, underutilization of sanctioned funds was observed. In case of dengue, actual expenditure was less than the sanctioned fund in all the years under the study period. Thank you.
Okay, Datta Kumar, I have only one question. And you have taken the government funding and you have covered both state government funding and central government funding, right?
Yes, sir.
Okay, then for your study, how did you define the rural area?
Rural area is the village where there are less than 5,000 people, sir.
Okay, okay, thank you. Okay, thank you. Next.
Next presenter, Dr. Balaji Bowie.
Yes, good morning, sir. Good afternoon.
Yeah, please go ahead.
Sir, I am sharing the PPT. Is it visible?
Yes, it's visible.
Yes, thank you, sir.
Please go through your objectives, methodology, findings, and conclusion. Yeah.
Okay, yeah. I'm going to present the paper on the revenue registration and the GST regime in India. Yes. The goods and service tax regime was introduced on 1st July 2017 in India for the replacement of the value-added tax regime with the objective of absolutely abolish the cascading effect and reform the Indian indirect taxation structure. The motive to introduce the GST regime to remove cascading effect and making reasonable prices for goods and services, to provide uniform tax procedures through the GST for nationwide platform, to improve the tax collection and minimize the leakage through IT-enabled network. Statement of research problem is the actual revenue collection might be progressive with the anticipated revenue under GST regime. There is a less explored research study on this area, so it has been taken for the research. Objectives of the study to examine the tangible revenue performance with the expected under GST regime, to analyze the revenue collection trends under GST scenario. Methodology, this is an exploratory research study based on the secondary data with reference to the statement of research problem and objectives of the study. The expected GST revenue had already been estimated for the financial year 2013-14 by then Chief Economic Advisor Committee to the Government of India using the indirect tax turnover approach, and demonstrated the GST revenue that rupees 3,27,728 crores and rupees 5,35,722 crores for the center and states respectively for the financial year 2013-14. So based on the cited figures for 2013-14 by CEA committee, the GDP has been considered by the researcher for estimating the expected revenue for the financial years from 2017-18 to 2020-21 for the purpose of making comparison with actual revenue. So this is the expected revenue under GST regime. The expected GST has been implemented in 2017, July 1st. So 2017-18 financial year. So centered expected GST revenue is 4,35,112 crores. For the states, 8,05,908 crores. Total it will be 12 crores 41 lakh 20. This is the total per annum for the financial year 17-18. So average will come 1 crore 3 lakh 418.33. So like that, the 2018-19, the total per annum 13 crores 79,512, and 2019-20 15 lakh 27,172, and 2021 the 16 lakh 44,245. So this is the expected GST revenue per annum for 2017-18, 18-19, 19-20, 2021. But actual revenue, tangible revenue under GST regime, in 2017-18, total GST revenue for the central state, it was 7 lakh 40,650, and average per month 82,294.42. So 2018-19 actual revenue 11 lakh 77,369, and average 98,114.08. 2019-20, 12,22,141, and the average per month it is 1 crore 1,0845.08. And 2021, 11,36,775, and average per month 94,731.25. So this data has been collected from the Ministry of Finance and the Central Board for the Indirect Tax and Customs Government of India. So comparison of expected and actual revenue. So expected per annum and actual per annum is compared per annum and also per month, average per month also. So that actual major findings, the GST revenue for tangible is compared with the expected. It indicates that the actual GST revenue is generated lower than the projected for the past all 4 financial years, as 20.42%, and first year, second year 14.65%, and third year 19.97%, and in the last fourth year 30.86% for the financial year 2017, 18, 18-19, 19-20, and 2021 respectively. So the revenue for the month of March in the financial year 1920 was unexpectedly shortfall, as there might be one of the reason of COVID-19 lockdown in all over India during the last week of March 2020. And the revenue for the financial year 2021 might also be affected the COVID pandemic lockdown with the first and second waves. The conclusion, the investigation is necessary for the revenue shortfall for the financial year 2018-19 and 19-20 by the concerned department. The revenue shortfall for the financial year 2021 would be expected as a major cause of COVID-19 pandemic, but only COVID-19 pandemic may not be the accurate reason. Therefore, it also required to be investigated for the shortfall in revenue. Yes. Thank you, sir.
Yes, sir. Balaji, sir, it's a good presentation, and I have only one question. You have shown number of years and expected GST revenue as well as the collected GST generated GST revenue. And excluding COVID cases, during other years, what is the reason for collecting, generating less revenue compared to the expected revenue?
Maybe that due to the you used to see in every newspaper there is a fraud in input tax credit practices in the GST, so that may be the reason, sir.
Okay. What is the reason for keeping petrol and diesel out of GST?
So that tax will come under the petrol is about to come under the GST regime, but there is a cess in that.
With reference to revenue collection, generating revenue, is there any impact?
Yes, actually the petrol products will have petrol, not only petrol and also tobacco products, and also some alcohol products, and these all products kept away from the GST revenue. These products will consume the 28% tax rate along with the high percentage of cess to get the more generation, because since the tobacco and alcohol product is a demerit product, and this petrol is a comfort product, the luxurious comfort product. So that is why these things have been kept outside the purview of the GST regime. But GST Council is planning to consider the petroleum product into the GST regime shortly.
So if it is brought, then revenue generated will be less.
Yeah, of course, definitely, sir. But actually, they may do some other models also in the GST for the petrol product.
Yeah. Okay, Balaji. Okay, it's a good presentation. Thank you. I think the last paper. Next one is the last paper. Organizer,
Presentation.
please.
We have done with the presentation, sir.
Oh, okay. Only 6 papers. Okay, thank you. And total 6 papers have been presented, and these papers have been presented on different topics. And all the presenters who have put a lot of effort in collecting the data and analyzing the data and coming out with the very good findings. I think we can. Is there anything to go, or shall we conclude this session? Organizers?
Yeah, yes, sir.
Yes, sir.
Yeah, please. From my side, it's
It gives me immense pleasure to deliver the vote of thanks to each and everyone who has made this paper presentation session a successful one. First and foremost, I would like to express my gratitude to the chairperson of today's paper presentation session, Dr. Abu Bakr Siddiq, Associate Professor, University College, Mangalore. Thank you, sir. Then, I would like to express my gratitude to all the participants and paper presenters of today's paper presentation session. I would also like to express my gratitude to all the faculty members, research scholars, and non-teaching staff for making this session a successful one. I would also like to thank my dear students for supporting the conduct of this session. Thank you one and all.
Thank you. Thank you very much.
Thank you, sir.
Thank you, Vedo sir, if you are hearing me, for the opportunity given. Thank you. Thank you very much.
Sir, 1 minute.
Yeah.
Dear participants, feedback form is available in the chat box. It will be available for next 10 minutes. Please fill it up. Thank you, sir, and thank you all the participants for your kind participation. The end of one chapter is just the beginning of another. Now, we have come to the end of 5th day of the 7-day event, and another informative day is waiting for you tomorrow. Until then, this is Anushree, student, Department of Studies in Commerce, Mangalore University, signing off. Thank you. Stay safe.
Thank you.